Hook and promise. Hey everyone, welcome back to the Capital Breakdown. Today, we're diving into a question that might surprise you. Are you quietly losing thousands in fees inside funds you thought were cheap? It's easy to assume that because an ETF, or an exchange-traded fund, looks low cost on the surface, it's a no-brainer to invest in. But beneath that simplicity, hidden costs can chip away at your returns over time. By the end of this episode, you'll understand exactly what these fees are, how they sneak in, and what to watch out for so you can make smarter choices with your money. No jargon, no hype, just solid knowledge to help you take control of your investments. The problem or confusion: most people think ETFs are like buying a single low-cost ticket to the market's biggest hits, simple and straightforward. But here's the catch. Many investors overlook the small but persistent fees buried inside these funds. It's a bit like ordering a budget airline ticket and then realizing you're paying extra for every little add-on: your seat, your bags, even your snacks. Over time, those extra charges add up, and the same happens with ETFs. People often focus on the headline expense ratio, but miss other hidden costs that reduce their overall returns. It's not always obvious because these costs don't come as a separate bill. They're quietly deducted from the fund's performance. Core Concept explains. So, what exactly are these fees inside your ETF? Let's break it down with a simple analogy. Imagine your ETF is like a big basket filled with pieces of dozens or hundreds of companies. To keep that basket organized and running smoothly, there are costs, like paying the gardener who trims the plants, the security guard who watches over it, and the truck that delivers new plants. These costs are called the expense ratio, a small percentage taken out of the fund's assets every year. But that's just the start. There are also trading costs, like tolls on the roads the fund's managers use when they buy and sell stocks inside the basket. Plus, some ETFs use fancy financial tools that might add more fees or risks. The key terms to know are expense ratio, which covers management and operating costs, and trading costs, which are fees from buying and selling the underlying investments. Core Concept explained, continued. To visualize this, think of the expense ratio as a tiny leak in your bucket. It might seem insignificant day to day, but over years, that leak drains a noticeable amount of water. And if the fund manager frequently buys or sells stocks, those trading tolls add up too. That's why an ETF with a slightly higher expense ratio or more frequent trading can cost you more in the long run, even if it looks cheap up front. Understanding these hidden fees helps you see the full picture, so you're not caught off guard. How it actually works now. Let's pull back the curtain and see who's involved behind the scenes of your ETF. First, you have the investors. You, me, and millions of others, putting money into the fund. Then, there's the fund provider, the company that builds and manages the ETF. They hire portfolio managers who decide which stocks or bonds to buy to match the fund's goal. To keep everything running, the fund pays for administration, legal, marketing, and the custodians who safely hold the assets. When you buy or sell ETF shares, brokers and exchanges facilitate those trades, and regulators oversee the whole process to keep things fair. Every step in this chain involves cost, some obvious, some hidden, like the administrative expense ratio and trading cost we talked about earlier. All these fees are bundled into the fund's returns, which means you never get a separate invoice, but your investment grows a little less because of them. How it actually works, continued. It's also important to know that ETFs are designed to be tax efficient, but depending on how often the fund manager trades inside the fund, you might still face capital gains taxes. This tax drag is another indirect cost that can affect your net returns, especially in taxable accounts. So while ETFs generally keep costs low, the complexity behind the scenes means you need to look beyond the headline numbers to understand the full cost picture. Simple, concrete examples. Let's walk through a couple of simple scenarios to see how this plays out. Imagine someone named Sarah who invests $500 every month into a broad index ETF with an expense ratio of 0.1%. Over 20 years, that small fee might feel negligible, but combined with other hidden costs and compounding, it can shave thousands off her portfolio's final value. The fee is like a small toll she pays monthly, quietly taking a chunk from her investment growth. Now picture Mike, who prefers to trade single stocks, including some high volatility tech companies. Mike might save on ETF fees, but faces different risks, like the chance of big price swings or concentration in just a few companies. Also, trading stocks often can trigger high commission costs and taxes, which eat into his gains. Both approaches have costs and risks. The difference is in where those costs show up and how they affect your money over time. Simple concrete examples continued emotionally. Sarah might feel comfortable knowing her investment is diversified and low cost. But if she doesn't watch fees carefully, she could be surprised by lower than expected returns. Mike might enjoy the thrill of picking winners, but he needs to be prepared for volatility and the possibility of losses. Both investors benefit from understanding the full cost picture and matching their strategy to their risk tolerance and goals. Risks, traps, and common mistakes. Now let's talk about common traps. One big mistake is focusing only on the expense ratio without considering trading costs, tax efficiency, or the fund's investment style. Some ETFs use leverage or complex strategies that increase risk and costs, which might not be obvious at first glance. Another trap is chasing the lowest fee at the expense of diversification or quality. A fund with a rock-bottom fee but a narrow focus could expose you to big swings and losses. Plus, trading ETFs frequently can trigger short-term capital gains taxes, reducing your net returns. Patience is key. Long-term investing usually benefits from minimizing costs and staying diversified rather than jumping around chasing the cheapest option or the hottest trend. Risks, traps, and common mistakes continued. Remember, any investment carries risk, and ETFs are no exception. Single stocks or leveraged ETFs can be especially risky for short-term traders or those without a clear plan. The best approach is to understand what you're buying, how fees and risks affect you, and to keep expectations realistic. No fund or strategy guarantees success, so always be prepared for ups and downs. How to think about this tool when thinking about ETFs as part of your financial life. It helps to see them as one tool in your toolbox. They can be great for building a diversified portfolio, especially if you're focused on long-term goals like retirement. But before you invest, make sure your basics are in place, like a solid emergency fund and a clear budget. Then, think about your time horizon and risk tolerance. ETFs can help spread risk across many companies, but they're not a set-it-and-forget-it magic bullet. Good investing involves regular check-ins, understanding costs, and aligning your choices with your personal financial goals, not chasing the lowest fee or the next hot fund without a plan. How to think about this tool continued. Also, consider how ETFs fit with other assets you own. Stocks, bonds, cash, or real estate. Diversification across different types of investments can help smooth out volatility and improve your chances of reaching your goals. Keep in mind that fees are just one piece of the puzzle. The overall strategy, your discipline, and informed decisions matter just as much, if not more. Recap and educational disclaimer. Alright, let's wrap up the capital breakdown with a quick recap. Today, we uncovered that ETFs, while often low cost, have hidden fees beyond the headline expense ratio, like trading costs and tax impacts that quietly reduce your return. We saw how these fees work behind the scenes, who's involved, and why understanding them is key to making informed choices. Remember, every investment carries risk, and fees are just one factor to consider. This episode is purely educational and not personalized financial advice. Always do your own research and consider consulting a qualified professional before making investment decisions. Thanks for tuning in, and here's to building your financial confidence, one step at a time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.